Started. So thank you all for joining. Some of you are new, some of you are returning guests. Welcome, welcome. This is Friday Night Lights. We run this every Friday night, 7 o'clock. The call has been running for about a year, almost a year and a half. And we've essentially set this call up very specifically to be able to pass on information that we've learned, to give information as we go through, like we're currently going through the purchase of a property, and we'll talk about that towards the end of the call. And we've been over the past couple months walking you through each step because I know a lot of the stuff that you might get from whether it's grant or whatever group, it's kind of like the 10,000 foot level, and we want to go into sometimes the details so that you know what you're walking into. We also welcome any type of questions you guys might have that you hadn't been able to ask, or maybe the group was too big and you didn't want to ask. And so this is a more intimate um, environment for us to kind of ask questions and do things. Over this past week, myself and a bunch of folks on this call were at the Grant Cardone Real Estate Summit. It was a fantastic couple of days, Monday, Tuesday, and then some of us left Wednesday. And it was just a really great time to connect with folks and really just see a lot of you and continue to learn and grow our network. Tonight, our goal is just to kind of walk through some underwriting. I thought, as well as Teresa, Tim, and Laura, felt like coming off of a real estate summit, if you've been there, and Grant kind of talks about a lot of stuff and he goes through all these numbers, but really kind of giving a different perspective on underwriting and how that works. And Tim does an amazing job at underwriting. He's really perfected it. And so we'll walk through that today. The other thing, that's like my little disclaimer here, is we are not lawyers, SEC lawyers. We are not tax accountants. We are not financial advisors. So again, we do our best to bring the information to you that we know. So this is more for educational purposes only. Always, always, always do your own due diligence when you go through anything. But feel free to ask us questions in that information, and we will gladly help out and try our best to work that through with you. So, with that, I'm going to turn it over to Tim to kind of walk us through some underwriting and allow him to do that. And after he's done, this call usually runs till about 8:30 Eastern time. And so for the last maybe 15 minutes or so, we will walk through our particular journey with a property that we have in St. Louis. So, Tim?
Alrighty. Alrighty. How's everybody doing tonight? Hopefully good. What I wanted to do, I was going to take a little bit different approach to what I normally do. Instead of just jumping right into spreadsheets and all that kind of stuff, I kind of wanted to do a little bit of an overview of kind of what underwriting is, what goes into it, what it is, what it isn't, those types of things. But I guess really what I want to start out doing is by saying why it's important that everybody needs to underwrite. I know I've heard why you need to learn to underwrite. I've heard a lot of people, when they get into this, because they're not, not everybody's into the numbers and the spreadsheets and all that kind of stuff. So they kind of dismiss that and say, I'll leave that to somebody else. I'll do some other things. But even if you're not going to be an underwriter for deals, you still need to learn how to do it for your own purposes, for your own good. Because what I've learned by doing underwriting, or what I learned early on, was when you get into it, when you get a really good underwriting tool and you really learn what goes into it, what it takes to underwrite, what the information is, where you get the information, and what the information means and what it's telling you, you really learn how the entire business of multifamily really works. You also learn, you know, the terminology, how to discuss things in terms of, what all the different things that go into the underwriting. And it gives you credibility when you have discussions with brokers or with other partners, with lenders. People, they can tell, whether or not you understand what you're doing by the way that you talk about, the deals that you're looking at. And when you learn to underwrite them, you'll understand them and be able to talk about it in a way that you just can't do it without that level of understanding. So I always say that before I get into that, because I really think that that's really important to understand about underwriting. Like I said, you don't have to be the one that's going to be the underwriting for your deals, for your partnerships or whatever else, but you really need to you need to do it and you need to understand it. It's really important, I believe. So anyway, what I was going to do is start out by I had a few slides I would go over. If I've got enough time, I'll through. I have a couple of deals. I could show you spreadsheets that I use and kind of what goes into those as well. But what I wanted to do was walk through how to underwrite a multifamily property, and whether you're on the acquisition side or working with lenders or just trying to understand how investment decisions are made, the goals are the same. And by the end of this, hopefully, you'll be able to look at a deal and understand what the numbers are actually telling you, not just whether they add up, but what story they're telling you about the asset. Um, you can see my slides, okay, right, Jason?
I can see him.
Yes, I could see it.
Okay,
Yes,
I just want to make
everything's.
sure.
Yep, you're on
I
slide
didn't want to
two.
get too I didn't want to get too far into it and then realize
Without
nobody can tell
sharing,
what I'm.
right?
Yeah, yeah. Uh, so what we're going to move through is six core areas. We're going to start out with what underwriting actually is, why it matters, then build through the income model, operating expenses, debt, and returns. We'll also spend some time on something that doesn't get covered very often, which is how to interpret the numbers, what they mean, and not just how to calculate them. And that's where the real skill lives, I believe. Um, at its core, underwriting is a projection exercise. You're taking everything you know about a property, its rents, expenses, market, and building a financial model that answers one fundamental question: does the deal make sense? And that's really what you want to know when you do this. Lenders use it to decide whether they're going to make a loan. Uh, Equity investors use it to decide whether they're going to write a check. Asset managers use it to track whether a property is performing the way that it was underwritten to do. So the tool is the same, but what changes is what you're solving for. Now, when I say the tool is the same, it's the same for you, but there are multiple different underwriting tools, and those are not all the same. And so, understanding what the differences between those are and what it's telling you is an important thing too. I might get into that a little bit more later. Um, but importantly, underwriting is not something you just do once at an acquisition, but you will probably revisit it many times throughout the process and throughout your hold period as well. So first of all, you start with the income. So everything starts with that. The first number you build is the gross potential rent. That's simply every unit at the rent fully occupied for 12 months in a year. And that's the theoretical ceiling. From there, we work down. You subtract physical vacancy, and that's units that are empty. You subtract concessions and loss to lease. Those are free rent periods, or maybe cases where tenants are not paying, the full rent. And what those two things are known as physical vacancy and concessions and loss to lease. And sometimes you add in bad debt as well. That is known as economic vacancy, which is a term that you'll hear from time to time. But just so you understand what that is, um, but that's important to understand, how that works into this. And then from there, you add back other income such as parking, if you charge for laundry, pet fees, utility reimbursements, and those types of things. And then what we land on is the effective gross income, the EGI. This is the real income based on the real income that we base our work from. Every assumption you make in this section has a direct impact on everything that follows. So this is where you want to be rigorous about your market research. So operating expenses and NOI. So now we look at what it costs to actually run the property. The operating expenses fall into three buckets. They're fixed costs, which are things like property taxes, insurance, which don't change much with occupancy. Then you have variable costs, which move with how the property operates, such as maintenance, utilities, landscaping, management fees, um, and management fees are usually typically 3 to 6% of the EGI, depending on size of the property. Uh, then there are the capital reserves, and that's the money that's set aside for bigger ticket replacements like roofs, HVACs, appliances. Sellers often underestimate or omit reserves entirely. So you always want to add those back and know whether or not they're including it in their financial information that you're getting from the seller. Healthy multifamily property typically runs at an expense ratio, and that's the operating expenses as a percent of the EGI, somewhere between 35 and 50%. If someone shows you a 25% expense ratio, that should immediately raise a red flag. So you want to understand that. But subtracting those total operating expenses from EGI, you get a net operating income, and that's the single most important number in the model. Everything else builds from that. Now you want to talk about the debt side of things. Once you have the NOI, you can size the debt. Lenders use three primary constraints on the loan amount. Uh, um, in the loan amount is whatever the most conservative of the three items allows. So the first is the loan to value, which most lenders won't go above 75 to 80%. We typically use 65 to 70% on the deals that we look at, just to be more conservative. The second is the debt service cover ratio, the DSCR, which is the NOI divided by the annual loan payment. Lenders typically require a minimum of 1.25, uh, meaning that the property generates 25% more income than it needs to cover the debt. If you drop below that or drop below one, that means the property literally can't service the loan. So lenders won't usually do that. So, and then anything above 1.25 just means you have a healthier coverage on that for your loan. And the third constraint is the debt yield. NOI is divided by the loan amount. And this one is particularly important because it doesn't depend on interest rates or appraisals. It's pure measure of the income against the loan balance. And most lenders want to see at least 8%. If rates are low and values are high, the debt yield is often the constraint that bites first. So then you get to the once you go through the income and the expenses and look at the debt and that kind of thing, then you get to the key return metrics. And now that means now you can evaluate the deal and what it actually returns to equity. The cap rate tells you how the market is pricing the asset. NOI divided by the purchase price is how you get the cap rate. It's an unlevered yield, so it ignores financing entirely. Um, it's most useful for comparing assets against each other and against market benchmarks. Cash on cash measures the annual cash return on the equity you actually invested. It accounts for leverage. So a 5% cap rate property can still generate an 8% cash on cash if it's financed well. The IRR is the internal rate of return. It's the time weighted return across the full hold period, including the sale. It's the most comprehensive measure, and most institutional investors have a minimum IRR hurdle that they won't go below. The equity multiple is the simpler how many times did you get your money back? A 2.0x means you doubled your investment. INR and equity multiple tell you different things. The IRR rewards speed and equity, and multiple rewards scale, and you want both to be strong. So this is something that you don't hear a lot of talk about, but it's probably one of the more important things to do, especially when it comes time to dealing with investors, and that's doing stress testing. So no underwriting model is complete without this. So the question, or where you want to, we run it into minimum of three scenarios. You have the base case, and then you have an upside and a downside. The variable that matters the most are vacancy, rent growth, and exit cap rate, interest rate, and operating expense ratio. Small movements in exit cap rate in particular can have an outsized impact on returns. Um, a 1 point expansion in the cap rate on a $10 million property is a $2 million reduction in value. So if your deal only works in the base case, it's not a good deal. So you want to be able to absorb a meaningful downside scenario and still cover your debt and return something to equity. And that's the margin of safety. So here's the part that it's really my favorite part of the underwriting part of it. It's about what's the story that's being told by all this information and all these numbers. This is what I encourage you to spend the most time with, because this is where the underwriting becomes a skill rather than a process. The numbers in any deal are telling you something about the asset. You just have to know how to read them. Vacancy that's well below the submarket average isn't just a line item. It's telling you something is wrong. Management, maintenance, the unit mix, the location, an expense ratio below 30% almost always means that the seller is presenting a misleading picture, whether intentionally or not. Rent significantly below the market could mean value upside, or it could mean that the tenant base simply can't afford more. You need to know which one before you underwrite aggressive rent bumps. NOI growing while occupancy staying flat is a classic pre-sale pattern where sellers push rents to inflate the headline number before going to market. And negative leverage, where the cap rate is below the cost of debt, means that math only works if you execute perfectly on rent growth and exit at a favor cap rate. That's a lot of things that have to go right. So a little more of a risky scenario there. So the best underwriters develop a sixth sense for these patterns, and the numbers are always telling you a story. Your job is to make sure you understand the story before you commit capital. Now, putting it all together into a workflow, it starts with the data. So the two things that you almost have to have, well, you have to have, no doubt about it, is the rent roll and the T12 to be able to underwrite appropriately. And then you need to find some tool or do some research on getting rent comps for the property that you're looking at as well. And then you build the income model, project expenses, calculate the NOI, size the debt, model equity returns, and then stress test. And that's pretty much the sequence that you go through. What I'd add is this: the model is a tool; it's not a decision. The decision comes from understanding what the model is telling you and comparing it against your investment criteria and making the judgment call about your risk and reward. Discipline of underwriting is what gives you confidence to make that call. So the key takeaways from what I just covered, and anybody that wants any slides, we can send these out to you. I know I kind of went through it a little fast, but the key takeaways from this is that the NOI is the foundation. Everything flows from it. The DSCR and the LTV constrain how much the property can support. The cap rate values the asset. The IRR evaluates the investment. Always stress test, especially vacancy, rent growth, and exit cap. And also, uh, that old saying about garbage in is garbage out. Your model is only as good as the assumptions behind it, and the assumptions have to be grounded in real market data. So with that, I can get into first off, I guess I'll pause there and see if there's any questions about anything that I've talked about so far.
Yeah, so do folks have questions about what Tim talked about? I know some of you are asking if you go into more depth, but
Yeah.
there's a lot here. So specifically on the stuff that Tim just talked about, what kind of questions do you guys have?
So I got a question. Did someone else go first?
Yeah.
This is Joe from North Carolina. With the in the earlier slides, you had a utility reimbursement.
Yeah.
Is that like some sort of overage on the paying the utilities if the tenant, if the building isn't separate metered?
It's typically referred to as RUBS, which it's a utility. It's basically a way to recapture utility costs, and there's a number of different ways that people do it. I mean, a lot of older assets are not going to be individually metered, especially for like water and sewer. So usually they'll come up with some kind of a method of coming up with either like a flat fee or somehow trying to proportionally uh, apply the expenses that you have. So basically, it's a way to, it's if the property is paying for the expenses for the utilities such as sewer and water and electric and gas and those types of things, and then coming up with some kind of a method to bill that back to the tenants and have them pay that as a separate fee on top of their rent. So you're basically recapturing that expense for utilities.
Right. I see some of those um on the income side of the expense sheet, the income statement. And so to me, it seems like it's over calculating because there should be a utility expense somewhere that should be little below that. Because I mean, typically you're not that's not how we're making money. I mean, it's rent increases and value increases and not, make money off someone's water.
No, but it's a way that you're reducing expenses. So
Okay,
you got to look at your expenses and income. So the margin between your expenses and income is where the more you can drive that, the more that's going to increase your NOI. So yeah, you're making money by increasing rents, but you're also, if you're decreasing expenses, that's just as good as
for
increasing
sure.
income. So you're billing back an expense, you're recapturing your own expenses. So it's a way of reducing your own and having the tenants pay for those directly. And there's other charges as well besides utilities. I mean, you can bill back for trash as well. That's another thing.
Yeah,
Sometimes that's included in utilities. You can
I see
do
that in trash.
parking, you can do parking, pet rents, those types of things as well.
Perfect. Thank you.
So there's a question from Rebecca and from Mel. So Rebecca asked if we have sample spreadsheets, and I think you mentioned
Yeah.
we'll go over that in a second. And then Tim, Mel asked, have you come across lenders preferring to fund multifamily properties on lesser of 70% LTV or 125 DCR?
How do you come across lenders?
Yeah, have you ever come across lenders that prefer to fund the lesser of? So you're looking for a specific amount. You're underwriting with, like you said, you do it conservatively at 60% loan to value or perhaps a loan to cost. Sometimes lender will say, look, we care more about you covering the DCR or the debt service coverage ratio. So we will lend you the amount um, that supports a 1.25 debt service coverage ratio. And you'll have to put in the rest of the equity yourself. Have you ever come across that? I'm up in Canada, so that happens sometimes. I'm just wondering if it's just across different asset classes, or have you come across it with multifamily? You guys haven't experienced the same thing that we've experienced up here. We're in a position up here where rents are in decline in most of Canada. Interest rates are kind of high. Um, Wages aren't keeping up. So we're in a sort of saturated market with multifamily, save and except some of the provinces like Alberta and Saskatchewan, which are still riding a high. But here where I am in Toronto and Ontario, we're facing sort of a decline, right? It's your returns aren't as much, and the risk is seem to be higher. So banks are being even more conservative as to how much they're lending out.
No, actually, we haven't so far. I mean, we've actually had lenders that have been pretty, actually surprisingly, you know, positive toward that for us anyway. I mean, um, and maybe too, the deals that we've gone forward enough to get a lending quote on have been good enough deals to where we haven't really had to worry about that. We've had pretty high DSCRs on the ones that we've looked at, and so yeah, haven't really ran across one where they've restricted that on us very much.
Thank you, sir.
And then there was a question from Carol, but Teresa answered it. It was basically for the rest of the group, the difference between rent rolls and T12s.
Yeah. So the rent roll is basically it's like it's the list of every tenant, and they have one for every single month, and that gets updated every month by the property manager. So it's a list of every single tenant that's in each unit, and you see that entire list. You see the rent that they're paying, and then any other charges that you have like pet rent, the utility chargebacks, any other charges that you have will also have those itemized on the rent roll. But it'll also have every rent, and so it'll show the exact rent that each renter is paying. It's not necessarily going to be the same, even though you might see an OM that says, for a one bedroom, one bath, here's the rent. that doesn't necessarily mean that's what every renter is paying for that particular unit, because especially these days, because more and more property managers are going to dynamic renting, which it almost changes every day. It kind of depends on what the market's doing. So you'll see a whole lot of variable rents in there. And so that's why you've really got to take a look at the rent roll, because most of the time people have, we'll say on average is about a 12-month lease. Sometimes there's some that are a little more, some that are a little less, but typically they're 12 months. But if somebody rented one, let's say you're looking at a rent roll that's from March of 2026, and maybe they're going to be coming up on a rent renewal maybe in 2 or 3 months. That means they rented it almost a year ago, and so what the rent that they paid a year ago, um, and then you look at another tenant who maybe just moved in a month or so ago and they're paying a completely different rent. Is that rent higher or lower than the one last year? That gives you some kind of an indication what's going on with the rents. Did they have to lower the rent to get that person in there, the more recent one, you know, or are the rents higher, which means, hey, they're able to push them up now. Maybe they were lower back some time ago because they were worried about occupancy and maybe the market wasn't as good, but now they feel like it's getting stronger and they're able to ask more. So those are the kind of stories I'm talking about, by looking at all the financials and all the information that you're getting on these. But that rent roll is basically giving you that complete list of every tenant in the property. It shows you all the vacancies as well. It'll show if there's a unit in there that's vacant, it should have that as well. And so that's another way to verify the occupancy too, because you can count those number of vacant units and divide it by the total and see what the actual vacancy is for that. And then, like I said, you can, as you're going through a process, you get the one that they provide for you when you first find the deal, and they give that stuff to you, but then maybe you get through the process and maybe you're going to make an offer, you make an offer and you move down the road and a month or two goes by, you can ask for updated rent rolls and then to try to keep, to make sure you're watching things. Like the main thing I'm watching when I see those kind of things is vacancy, to see if, they're maintaining the occupancy like they need to. Rents may change in a month or two, but that's not going to really change the averages very much. But and there's a lot more I can go into on rent roll, but I could be here all night just talking about that.
Does it, of
Um,
course, it shows you if people aren't paying their rent, like if they're behind.
it will, if they are being honest about that, they will show people that are in arrears or something like that. I'm not going to say, and that's another thing. You really have to, even when you have these actual financial documents that they give you, you still need to be skeptical of them because they can still play games with them. Um,
Mhm.
but it is something too that they can be held to, because the rent rolls and the T12s. And by the way, I didn't explain what a T12 is. T12 is the financials. That's where your expenses are for all the things that it takes to operate the property, and it's the income that's coming in, as a whole for the property. So it's kind of like your line items. You have all these different line items of different items for income and for expenses, and so you can see then like how much is it costing them to maintain and repair? What's the cost for insurance? What's the cost for taxes? What's the cost for property management? Advertising and marketing. It'll have all those kind of categories of cost in the line item. And then as far as it'll show all the income too, it'll show whether they have pet rents and laundry chargebacks and pest control chargebacks, utility chargebacks, um, any other kind of income, parking, those kind of things as well. And so the two together gives you a full financial picture of what's going on with that property. And the other thing about a T12 is it shows you, usually it's the last 12 months, the most recent 12 months is what you really hope to get of the property. And it'll show you month by month. So you can look for, like in a particular expense, like maintenance and repair would be a good one you can watch for trends. Are those expenses going up or down? Or is there one that's way out of whack with the rest of them, way higher or way lower? And then that might raise a red flag. What happened there? Um, or maybe they're trying to hide certain costs in certain line items as opposed to reporting them. Like one of the things that they'll like to do is some operators prefer not to have concessions, for rents, because that some people may think that looks bad, that you're just You're just trying to do whatever it takes to get somebody to occupy the property. So they may hide that in like
Yeah.
vacancies or something like that, or bad debt or whatever. They may have it in some other category and not necessarily reporting it as a concession. Um, so those are the kind of things you just kind of look for, ask questions about. Anytime you can go through, I usually go through the T12 and will highlight things, anomalies or trends or whatever. I'll highlight them with in a color that reminds me I need to ask questions about that. So
Do you
And
like underwrite it with their numbers then? Like
yeah,
see if their
yeah,
numbers
I
up to
can show
their
you.
asking price?
Yeah, I can show you in a minute kind of what I do, how I do that.
Right.
and then so T12 is trailing 12 months, right? Sometimes you might see
Yeah,
T3, T6. The
Mhm.
number basically equates to the number of months.
yeah.
Okay.
So
Mhm. Other question is, how would you stress test? What is that? Like, how
So
would you do that?
so typically when most people underwrite, the 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 thing that they're looking to do is that, the first thing people want to do is they want to see what the upside is because they want to see what the potential for the property if they buy it is, right? So they'll usually look at, can we increase the rents? That's usually the main thing that they look at. And you'll see anywhere, 3%, 5%, 6%, whatever case may be. And that may be the way you underwrite. You may even do some research and find that the market that you're in will support a 3 or 4% rent increase, year by year. So you'll include that in your underwriting initially with the exact expenses and income, and you'll see what those returns are. And then maybe by doing that, you see, oh, those returns are pretty good. So I think I'm going to pursue this deal. But then I'm going to back up and say, okay, but what happens if those rents don't go
Mhm.
3%? I'm going to put 0% in and see what this deal looks like with no increases in rent. Or
Mhm.
maybe another scenario is I'm going to see what this deal looks like. I'm going to go back and I'm going to increase all the expenses by 7 or 10% and see what happens if the expenses all of a sudden, go up, inflation or whatever. And then, or
Okay.
maybe another scenario might be, okay, I'm getting the rent rolls. It's saying that it's a 7% vacancy, right? Well, I want to see what happens. What happens if that drops down to 10% or 12% vacancy? What does that do to the returns? So those are the kind of things where you're talking about a stress
I
test.
see.
You're getting, and then maybe you want to have a worst case scenario where you can say, what would be the worst thing that would happen? Maybe it would be no rent increases and expenses go up and occupancy drops. That would be a worst case scenario. Uh,
Yeah.
and see what happens then. But if you've got a deal that can survive all that and still squeak out a little bit of a return, that's probably going to be a pretty strong deal. So probably low risk anyway. So
Okay.
that's kind of what you mean
Okay.
by stress testing it. What
All
we
right.
typically do is we do a break even analysis on occupancy. We basically will look at the total income versus the expenses, and what would be the occupancy that you would have to drop to where you couldn't pay the bills and you couldn't pay any returns. And typically, what you're looking for there is anything below 80% is usually considered pretty decent. The deals that we've looked at recently have been down in the 60s, mid 60s to 70%, which means pretty strong likelihood that that's going to be a strong deal because the likelihood of your occupancy dropping down, unless there's just something that really goes wrong, is not very likely to do that if it's had a history of maintaining a good occupancy.
All right. So yeah, the deal in St. Louis has that. Huh.
Yeah, there's the one we
Very
use for
good.
that.
Yeah.
if you can
Very
see my
nice.
screen, I just threw it up here. That's an example of what Tim was talking about.
Yeah, we
The
Right.
still seeing the takeaways.
sorry. I think if you switch your screen to mine
Oh,
or just stop
the
sharing for a sec, I think
yeah,
it'll pop up.
I had to find where it was
Uh,
at. I got
there you
three
go.
screens
That's
open.
break even.
So this is a break-even analysis. So this is an example from our St. Louis property that we'll be closing on, but Tim did a break-even analysis, and what it essentially shows over the 5-year period, we could sustain a 60%, 66% occupancy. So the property is currently running at 95. So you'd need 30% of the people to leave and no one to fill their spot. And we would still be able to pay the bills. So it's just an example of kind of doing your break-even analysis to say this is how strong of a property it is, because we could still sustain and even pay minimal returns to investors and pay the bills at 66% occupancy. So you
That
kind
makes
of,
an investor feel really good.
right. It makes it like, okay, well, my money's probably pretty safe here, right?
And
Yeah.
that's probably one of the slides. Most of the pitches that I did, that one generated the most interest, most questions, and like you said, usually was the thing that convinced people that, you know, this is
Yeah.
their make this, and because that's what people are looking at. They're wanting to protect their capital. That's the number one thing, most investors. So, and this is kind of an indication of that. How is their capital protected?
There were a couple other questions here. Let me pull up the chat again. Brand new and really don't know where to start. What should I focus on first?
Um, that's a big question. You mean you mean with everything multifamily or just in underwriting? So,
Looks like it's just a general question. If you want to unmute yourself and ask.
Yeah, hi, this is Adrian, and I'm originally from St. Louis, Missouri, but currently living in Reno, Nevada. And yes, just a kind of general question, like where to start. I have, I've kind of been in the process maybe about 6 months. It's just like finding the deals and then being able to partner with somebody and knowing how to really underwrite business.
yeah, so that's a lot to cover. So usually what I encourage people when they first start, two things. I talk about learning truly how to underwrite, really focusing on that, not necessarily. Um, a lot of people want to jump right into a deal, and I mean we all did. We've been there and done that, but I try to recommend people not to worry about that as much as just learning how to underwrite, learning how to get the information that you need and analyze it, just like I talked about there, and really understand the lingo, the language, the concepts of what goes into it to understand the business. 'Cause that's how you're going to understand how multifamily business works. Um, and it's going to give you the credibility the better you understand it. Um, the good credibility of having discussions with brokers and having discussions with other partners. I can tell you, an experienced partner, the idea for the best thing you can do as a beginner is if you can find an existing partnership or people who have experience and you can partner with them, that's going to be the best way that you can get further along in your journey. But I can tell you one thing, an experienced partner, the one thing they're not going to want to hear if you come in and you can say, I don't know anything about underwriting and I just can't do that. That's just not something I'm interested in. You don't ever want to do that because for one, that shows you're not really committed enough to really learn something because that's something you've really got to do. You got to do things that are not comfortable in this. And sometimes it's learning things that you might not like, but it's an extremely important part of it. Like I said, you don't have to be an expert at it, and you don't have to be the one that everybody depends on, but you still need to understand it and do it. So, finding deals, and we can talk about ways of finding deals, but finding deals that are we always go back to looking at ones that are in your market, in your area. And the reason why that is not necessarily because you're going to underwrite that deal and do that deal. It's because you understand your area. You understand what costs are. You understand how property taxes work in your area. Uh, and you know where good neighborhoods are, where bad neighborhoods are, those types of things. So when you underwrite those properties, you can look at those kinds of information. That's the data that you're looking for, and when you put it into your model and you analyze it, you get a feel for how the whole underwriting works. And it's easier to do when you're doing it in a market that you already understand. Now, and so I would just do as many properties as you can. Um, And I'm seeing Bill there. I'm getting a little nervous. He's going to shoot me. Anyway, sorry, I got distracted.
He's
Don't
got a
normally
BB
see that
gun.
on a Zoom.
Yeah.
Thank you for that information.
The only other thing I might add to that is, if possible, and I know this isn't the case for everybody, invest as an LP with the deal. And that will bring you along the journey. It will help you with a lot of the terminology. You'll be able to kind of follow along with them and really learn. That's how I started too. And then I did all the stuff that Tim talked about on top of that. But it was helpful to go along with it because it kind of worked hand in hand. I was watching it happen at the same time as it was happening, and then I was doing it too. So you're kind of hearing it, you're seeing it, and then you're doing it. So you're kind of working all of those skill
Yeah.
sets together.
That I would add in terms of like, besides underwriting, another thing that's important to do is networking. So, partnering, we talked, like I said, about finding the ideal thing for you to do is if you could find an existing partnership with people that are experienced. Well, the best way to do that is you just need to network in as many different ways as you can. You can get on every Zoom call that there is, especially the better Zoom calls to get on are ones that where people interact with each other and you're allowed to talk to each other. Not There's a lot of Zoom calls you get on and the presenters present and you don't really get to you can ask questions in the chat, but you don't get to really interact with people. It's a little harder to get to know people that way. So get on as many Zoom calls as you can where people are interacting and asking questions and talking to each other, exchanging information on how to contact, and then follow up on those and interact with as many people as you can. And it may be that those initial contacts that you make when you first talk to someone may not go anywhere, may not result in any kind of partnership or anything like that, but they may lead you to some other contact with someone else that could lead to something. So I followed every one of those as far as I could go until I ran into a dead end, and didn't get any more contacts. And just networking over and over again, as many ways as you can, is the two things I would concentrate on would be, like I said, with about the underwriting and then networking. Those are the main things.
Yeah, those are great.
And this is the
All
most
right.
important call to be on, right?
Yeah,
You-
that too.
yeah.
That too.
I agree.
We think so.
Nice.
Not
I'm in the
biased
right
or
place.
anything.
I'm in the
Yeah,
right place.
So Mel has a question again. Do you use the gross rent multiplier as a metric? If so, in your opinion, what is your benchmark for GRM if you need to satisfy?
I don't use that. Uh, so yeah.
So
I
you
don't
don't
know
have
if
to
that,
answer this. You don't have to answer the
yeah,
second part.
don't have
Good
anything
answer,
to
Tim.
elaborate on, so I don't use that.
All right, cool. No, yeah, some people go into underwriting an asset or just trying to figure out whether an asset is worth pursuing based on that multiple, right? It's just like a stock multiple or a price to earnings multiple. So you're taking your market value of the asset, dividing it by its gross rent, and you want it to achieve a certain you'll get your money back in a certain amount of time, right? Usually a multiple's between 4 and 7, but it's not always that way. It all depends on what the economic environment is around there. So you never want to take on any more risk than you have to. But I'm wondering how stringent and how conservative you are in your underwriting when you're pursuing opportunities that are out there. So would it be a 4 multiple? Would it be a 7? Are you a little more lax? Maybe you don't care. In this particular case, you don't use it. So that tells me a lot because you do know a lot and you have enough other metrics to rely on
Yeah.
that you're not focused on the one. Thanks
Yeah.
for sharing.
Yeah, I think for me, it's more about understanding the market that I'm in, the conditions of the market, and then when I underwrite a deal, if, like I said before, if the deal is only going to be a good deal, if everything has to go right, you know, in rent increases and those types of things, expenses are controlled and all that, um, then that's kind of where my biggest risk factor goes. And uh, I don't want to do a deal where, I mean, if I say the rents are going to have to go up 5%, 6% on average over the next 5 years, or this deal's not going to work, I'm not going to be as comfortable doing that. If it's in a market to where, the last 5 years, the rent growth has only been 2 to 3%, So that's kind of the philosophy that I use in terms of, managing, looking at the risk that I'm involved once, comparing it to the underwriting that I'm doing.
Right. So Garth's question is, when do you go from back of the napkin to detailed underwriting?
Yeah. So usually the first thing I do is when I get the OM, which is the offering offer memorandum, hard for me to say, which is basically, let me show you a little bit about that. I'll show you while I talk, in case you haven't seen these. Everybody see that okay?
Yes, we can see. It's a lot
So
of spreadsheets. You got like, yeah,
so
cool.
here's an OM for a property that we like to have here in the Kansas City area. And typically to do a back of the napkin underwriting, the first thing I'll do, I'll go into the OM and I'll search for, a little harder for this one. They got this one buried. So here they'll usually have some kind of a breakdown. This is on the unit mix and the average rents and all that. So with this one here, you can see that it's saying that and they'll use different terminology and it's kind of confusing to them sometimes. This one says current target rent, and then it'll talk about monthly market rent, upgraded market rent. So you just kind of got to get used to what those mean. They'll use different terminology, but typically this current rent is what's when you look in the rent roll, this should be showing what the current rents are right now. And you can see down here at the bottom, we've got an overall average rent. So that's 10.99. So that's what I'll use for the back of the napkin. I'll use that. And then somewhere in here, usually they'll have some kind of let me go back up here. Hopefully they'll have some kind of um, place where they'll mention what the occupancy is. Um, and it's hard to find, obviously. I'm not seeing where it is
While
on
you're
this one.
looking, I usually try to, if you don't mind me interjecting, I usually try to take and do a Google search as well to see like what Zillow has for like how many units they have available for rent. That means
Yeah,
they're doing the marketing, and you can kind of get a little bit, at least fact check.
yeah.
Always
I
double
mean,
check
sometimes
numbers.
in some of these properties that may be the only way you can get it. If you just use, and sometimes it's not bad to look that up anyway, even if they do have it here in the. So this one's
94%.
showing
There
here
you go.
here here. So it's
Yeah.
94% here. So those are some of the basic things, and then I get those off of the OM, and then I'll go to. They'll have a financial analysis as well, where you can see, and usually go to the T12 column here, where you can see the income and expenses. So looking at that, I mean, it's hard to show this all on one screen. Uh, here's an example of the rent roll or the T12 for this property. And here is the rent roll, just to show you that I had it. But here is the spreadsheet that I use. So don't get too distracted about all of this. So right here, this little box right here is the underwriting that I do for the OM. And so this is the first thing I'll do. I'll come in and I'll put that rent that I found in the OM, the occupancy. Then I'll do a quick a calculation on what the other income is based on that financial um, tab that we had here. Let me see if you can see that. So I'll just use I'll use the income, the other income, which in this case is this number right here. If you divide that number by the total income, that's the percent. I'll put that number there. I do the same thing for the expenses for the income. I'll assume a cap rate the best that I can based on what I'm looking at. Sometimes I'll have it in there, sometimes I don't. Usually I've already talked to the broker by now, so I'll have a good feel for what they're underwriting it at. Just one of the questions I usually ask a broker is what are they underwriting this to? What cap rate are they underwriting it to? And then I'll put that in there. And then this does that quick right here. That does the calculation right there that basically you see Grant do, where you multiply the rent times 12 by the number of units, and it's got the number of units over here. I'll put that in as some of the input, um, and then it'll take into account the other income, apply the expense rate and the cap rate, and it comes up with an NOI. So that's the quick version of that. And then I'll usually put in this. This is a number that I'll put in the NOI that they're showing in the OM. So in this case, it's 1,456,000. I'll put that in there. So that gives me a side-by-side comparison. This is what they're showing in the OM. This is what I'm getting when I do the back of the napkin. That's just a quick comparison right there of, you know, is that close? Does that mean the OM? Um, in this case, it's actually showing that the OM is a little less optimistic than just that quick back of the napkin underwriting. Um, I won't get into all these numbers now. That'll take too long to explain. Um, by the way, anybody wants to know more about this, I can go into a lot more detail with this. I meet with a lot of people one on one. If you want me to meet with me to do that, I'd be glad to do that. Let me. I'll put my number in the chat here in a minute. I'll run my picture up here, and then you can text me if you want to go into more detail. But anyway, so once I do that, that kind of gives me a basic idea. Once I have the NOI and the cap rate, um, I do a quick calculation. Then this is kind of the value, the 22.4. This is based on the OM NOI. And then I do another calculation. Grant showed a hack on some time back. I haven't seen him do it in a while, but he showed one where you can do a calculation using the NOI of where you apply the DSCR ratio. Um, you basically take the NOI, multiply it by 0.8, which is the same thing as dividing it by 1.25, which is that DSCR ratio that lenders want to see. And then dividing that by 1.25% added to the interest rate that you're assuming. So in this case, I have a 6% interest rate. So dividing that by 7.25, and that shows you that number right there would be the debt that this NOI right here could support. And then based on a 70% loan to value, usually that gives you the value that would support. So that's 24, 22. Those are pretty close in numbers. So that's coming in on about a $24 million, 22 to $24 million range on the value, just based on the back of the napkin.
And that formula is the debt service divided by the interest factor plus 1.25. And that will give you the loan amount.
Yeah, I
So
think
it looks like, so then I would compare that to if they told me in this case that they're saying the guidance, the broker said the guidance on it is $25 million. That's what they're looking for. That 22 to 23 tells me that that's not too far off. So it's close enough to me to dive in a little bit deeper. If there was, I've seen some that's come in where, you know, this number over here might be, you know, 15 or 16 million, and they're asking 25 million. You know, that's a little too far off for me to see how I'm ever going to get those numbers to work out. So a lot of times I might move on at that point. So just to kind of, that's just kind of a rough idea of when I decide to move on from under back of the napkin or not. But I would still encourage people that if you haven't done underwriting very much, um, I would do the more detailed underwriting if you can get a hold of a good underwriting tool, because again, that's going to show you more about the deal. So let me just real briefly talk about the more detailed underwriting. So
Real quick, before you go into that, there's one more question. When adjusting for new taxes, how do we account for that underwriting?
that's That's where I can show you in the spreadsheet kind of how it
Okay.
does that. But
Go
basically,
ahead.
what I do is I mean, I take the existing taxes. It really depends on where you're at. I mean, every county and every in the country does it a little differently. So I can tell you for Missouri, typically what happens is Missouri uh, assesses every county assesses every property every 2 years. They do it on the odd years, which means when they assess it in the odd year, your new tax will apply in the next year, and it'll be the same 2 years in a row, so it won't change. Um, and so, it's a little easier to do that. What it does in other states is, like Florida and I believe Texas, it'll reassess every time it's sold, and so you would have to use um, the purchase value to determine the taxes. But then you really need to talk to, if you really want to know how much to adjust your taxes for, you need to talk to someone who is a property tax expert in the area where you're buying the property that knows how that works and let you know how to calculate that. Because in those states where they reassess it at every purchase, you need to factor in that increase in taxes, or you know I would never decrease them, but keep them the same or increase them. I would always add an increase in. I always do a minimum of 10 to 15%, on every deal, even if it looks like they're not going to change that much. Just again, just to be conservative. So anyway, you put all this information in, like the number of units. This is a assumed purchase price. It does all this calculations on, this loan amount is based on what loan to value I put in. Um, in this case, I have 67%. I would usually have 70 there. Anyway, and then you would put in your assumed cap rates going in, going out, number of years of amortization, all these kind of things, all your fees, the acquisition fees, disposition fees, and asset management fees. You put all this stuff in, the interest rate that you're assuming, number of years of interest only. These are all basic input information that you put in at the very beginning, and you would use that in just about any underwriting tool. Anyway, then on this particular spreadsheet, this has a financial spreadsheet that you remember the T12 that I told you about. It's all the list of all the itemized items for all the income up here. So you can see here for the gross rent, the bad debt, vacancy loss, concessions, and all that. All those are itemized here. Other income is itemized by all the different types of income that you might have. Not every property is going to have every one of these. So you may only have numbers here for the ones that apply to your property. It'll add all up all that income, and then you put in all your expenses. It's itemized out here as well, for and all these contracted services, property insurance, taxes, whatever else, maintenance and repair, all those different expenses, and then it'll add up your expenses, and then it'll do a calculation where it'll subtract the expenses from the income, and it'll come up with your NOI. So, and then you can see in this case, these are the seller's numbers. So these are based on the numbers that I pulled directly off of the T12. And then I go in and put in the numbers that I believe it would be what we would do when we take the property over and how we would operate it. And so I'll put numbers in here. Usually I carry them over pretty close to what the numbers are, especially on the income side. There may be some income that I don't include at all because it's not something that you necessarily want to depend on. Um, some income, especially like late fees and stuff like that. You don't, those are income, but they're not necessarily the kind of income that you want to have. Anyway, so I would go in and input numbers that I believe that we would operate it by. Expenses is where I really do most of the inputting the way we do things, such as insurance is a case where I put a number in based on we have a master insurance policy across multiple properties. So I know about the range, depending on our property, of what it's going to cost us for insurance. So I'll put that in regardless of what the sellers are showing. Um, and then the property management fee is a number that carries over from the input based on the percentage that I put in there. In this case, it's 3%. Then the payroll is another number that's calculated on how you think the payroll is going to be. If you're going to have employees, number of employees by the salaries and benefits and that type of thing. Expense ratio, uh, just how much, usually you usually look at a $300 to $500 a unit on maintenance repairs, and unit turn costs about the same, 250 to 300. Property taxes, this is where I was talking about before. This is what they were paying on the property taxes. This would be about a 10% increase. So you can see where I've added in an increase even in the year that we take it over for property taxes. So it's where it takes that into account. And by the way, I should say that as I'm
When
putting
you,
numbers, as I'm putting numbers in this column, it's carrying it forward automatically on all these other, this would be year 1 through year 5. So it's carrying all those numbers forward automatically. I don't enter anything over there. Um, and it adds an increase. Like if I'm going to say that the expenses are going to increase by 2%, per year, it'll increase all those expenses by 2% a year.
I think somebody had a question. Who was talking?
oh, so if you say like the property management's 3%, is it 3% of the loan amount? Is it
of the
3%
of the
of
income,
of the
effective gross income. Yeah.
effective gross income? Okay.
And the rule of thumb on property management is the smaller the property, the higher percentage is going to be. So usually we're looking at somewhere around 100-unit property. That's going to probably be for us, it's a little different because we have our own property management. So we keep ours at 3% regardless. But if you're
Mm-hmm.
going to be hiring a third-party property manager for 100-unit, you would probably be looking at a 4 to 5%, most likely. The
Okay.
bigger that goes, you would get closer to the 3%. I wouldn't go under 3% though for any property.
Okay.
So anyway, you get your NOI. So here's the NOI that um, according to the seller's numbers, this is the NOI that we come up with. And then this is what it would be for year 1 through 5. You can see here, this is where you deal with your placement reserves. Those capital reserves we talked about. That's at 300 a unit. This is where the debt service gets figured in. So I have another. This has got a tab. If you look on down at the bottom here, it's got all these tabs for taking all these things into account. But it's got a tab that figures all the loan. Here's the loan amortization. So it figures out what all those are, and it figures out what the debt payment is for this loan, and that puts that in there. So it'll take the NOI, subtract the replacement reserve, subtract the debt payment, and ends up with this is your net cash flow here. You take the net cash flow, this spreadsheet then will take your asset management fee, which is based on the percentage that you put in on the input, and it'll figure out what your asset management fee is. This is one of those things that I'll talk about. That this is where you need to really ask questions about on different underwriting tools do it differently. Ours is calculated. The percentage is calculated based on the income, so it's based on this number up here, this total income. So if we have a 2% asset management fee, it's 2% of this number. There are some people who they may do a 1 or 1.5 or 2% asset management fee, but they're actually doing it on the equity raised. So in this case, you can see the equity raised on this one is going to be like $9.4 million. So their asset management fee is going to be 4 times what it is here. So, which has a big effect on, you're taking that asset management fee, you're taking that off of the excess cash flow. So that's directly impacting investors' fee, or the amount of money that's left for investors. So just something to understand about that, because again, that's one of those cases where not everybody underwrites things the same way. So just be aware there are different ways to do these calculations. It's not all the same. And then anyway, after you come down here, and this splits out the investors amounts. So basically, if you're doing a 90-10 or 80-20, this will speak 90% of the cash flow gets calculated here. This is what goes back to the LP investors, and then the 10% goes to the GP investors. And then this then also does calculations on what your cash on cash is for each year, your annual return, your IRR, and your equity multiple. Um, so this is just an example of this is a much more detailed and much more in-depth underwriting tool. you can see where it separates, your calculation for payroll and taxes. You can do a capital improvement plan here where you do improvement costs for interior and exterior and add that all in. And that factors all of these things that you're entering, even your closing costs. These things get gathered and put into your financial model. And then it calculates that when it calculates your return, it's taking all of these things into account when it's doing it.
Joe, I think you have a question.
Yeah, there's a lot of information. I don't want to interrupt.
Yeah,
When you go back to the investor breakout, so I'm looking at you guys had an X amount of cash flow, and then you had that 90-10 rule that you had to set up 90%, 10%.
yeah.
So
I just changed the date.
do you try to leave every month with no excess cash flow, or you typically leave some in there just for emergencies? I mean, clearly, if you leave a lot of money in there, it's wasted.
That's
Um,
where this replacement reserve comes in, because that's kind of what this money is you're setting some money aside
okay,
for unexpected expenses. You also do that.
so it's
We also
built in
have
there.
we also have some here where we talk about working capital reserve. So we have like usually put a large amount in there too, based on what your expenses are. Uh, you know, so it's actually fact. So this is the one amount here that we would have that gets factored in,
It's
as
kind of
well
factored
as
in, and then you reaching the zero.
right.
Okay.
Yeah, so when it reaches zero here, you can build it in wherever you want to in there, but it is built in this one.
Yeah, I guess the question is like when you have investors and you're trying to make some money, you're trying to get your investors paid. Um, that's where you're trying to just get them as much as that cash flow as
Right,
possible.
right.
Okay.
You're kind of balancing it out between doing what's responsible for the property. I mean, because having reserves is you're protecting the investors too. So even though, setting that money aside does take away from their returns, but it is also doing the responsible thing that's protecting their investment as well. So you kind of that's kind of a balancing act to do that.
Yeah.
But using industry standard numbers or typical numbers, that are reasonable, and that you can explain, are usually a good thing.
Yeah, I just wasn't sure if the property has essentially money in the bank every month all the
Yeah,
time that are just, you know, that
definitely.
answered my question. Thank you.
Yeah,
And keep in mind that the reserves are never lost, right? I mean, if everything
right.
went all peachy keen and you get to the end and you sell the property and you've got 100,000 in reserves, I mean, we would always pay that out, right? The investors would always benefit from that. So there's never where we're gonna keep it now. We're gonna pay it out just like we said we pay everything else out on an 80-20 or whatever the split was predetermined to be.
I will say too, this is another tab that gets factored in. This is where you put in your rent scenario. So that when you go to your rent roll, you determine your mix breakdown. And so for each type of unit that you have, the number of units, I put the square feet in there because sometimes, people want to know cost per square foot, or you just want to know that yourself. This is where you put in your effective rents, what the in place rents are, what the proven rents are, and then what your market rents that you think you can achieve. And this basically does a calculation that comes down to what this analysis would show if you to achieve these market rents would be about $100 a month rent increase over a 5-year plan. So I just wanted to show you that that gets factored in to those returns as well. So it's just to show you that there's a lot more that goes into actual underwriting than this version up here with the back of the napkin, and sometimes gives you quite a different picture than this back of the napkin underwriting does. Sometimes where you really feel good about it is when they all come in about the same within reason of each other. You know, otherwise you just I rely more on the more detailed version of it. Um, but still, it's good to do the other ones just to kind of know where you're at and comparing, what you're getting from the seller or the broker and from the actual detailed information.
I have a quick
All right,
question.
saw a hand raised. Show me.
Yes, yes. Hi. Um, so that 80/20 that you have on row 34 and 35, is that usually the standard for, I guess, the split between GP and LP 80/20, or it's like
I mean, it's what you see. It's most common,
what's common? Okay.
but it's really there is no set rule one way or the other. I've seen people do 70/30. Um, what we do is we typically do an 80/20 split for most of our investors. We actually have two tiers in our deals. So that's the first tier. The second tier would be for anybody investing $1 million or more as a single investor. We would give that 90/10 split.
Oh, so this is per investor?
Yeah.
Okay, I see.
Well, it's for all LPs, but each person gets the same. You would get 80%, but you would get 80% of um, whatever percent. So your investment is a certain percentage of the overall investment, right? So
Mm-hmm.
let's say you invest $100,000 in this deal, right?
Mm-hmm.
But there's $9.4 million total being invested in this deal by investors. So 100,000 divided by 9.4 million is whatever percent that is. That's a small percentage. Then that means you would take that percentage and multiply it by this. This is 80% of the overall. Your percentage would be that small percentage times this number.
I
Does that
see.
make
That
sense?
makes perfect sense. Yes.
So
Thank you.
all of this number goes to all of the LPs total.
Okay. Okay. Thank you so much.
Yeah.
Mel has a couple questions.
Yes, he does. So, do you typically project operating costs to grow indexed with inflation, or do you use an arbitrary number like 4%?
You typically try to do it based on what you think inflation is going to be, um, and maybe again, however conservative you want to be. Um, so yeah, I mean, typically I think I use a 3/2, which is 3% increase in rents, 2%. This one's got one, or that's other income. 2% in expenses is typically what I'm doing.
Yeah, typically I'll see inflation plus, a quarter point or a full point,
Yeah.
just to be conservative. I didn't want to ask you though. So sometimes in other asset classes like industrial or office, you'll get property management fees a little different. You might have a higher percentage, but it's not necessarily based on revenue. Typically, you would associate it with revenue as a performance thing, right? The higher the rents you get, the more you make on the property management. I've seen it
Right.
on other asset classes like industrial and office where it's sort of a hybrid, or they would just flat out charge you 15% on the operating expense. The reason being is because operating costs will always go up, whereas revenue may be flat, and so they always want to, benefit from inflation, right? It's always going to go up. And
Right.
I've seen hybrids, right? They might take a percentage of your operating cost plus a smaller percentage of the revenue. So this way they're hedging their bets as well. So property management companies would actually just constantly be in the positive. Have you seen anything like that in multifamily?
I have it in multifamily. No, it's usually just a straight percent. Whatever you assume you want your cost to go up, and that varies. Among operators. Some people are overly conservative, and some are less conservative.
Yeah,
Um,
I'm seeing that
but that
mainly with pension funds and institutional asset managers. They're
yeah,
sneaking it in there like that.
yeah. But what you're talking about just illustrates what I'm talking about too, about how there's so many different ways to underwrite these things. So again, no two ways of doing it are the same. So, but it's a good point to bring up that people need to be aware, because you hear a lot of people say, well, everybody has the same numbers, so we're all calculating it the same way. Well, that's not necessarily true.
Yeah. There's also different programs, different spreadsheets that he can use that have different formulas in it. The debt folks are going to
Yep.
underwrite differently than the brokers are going to underwrite. Look, everybody has a goal in mind. The broker's goal is to sell the property, so theirs is probably going to be inflated. Debt guy is going to be super conservative, so he doesn't lose his money. And we all would be somewhere in the middle of the two.
Yeah. So that's so an illustration of that is, so you can see here when you've got numbers, this is in year one, and then it goes to year two. Basically, these numbers are about 2% more, and that's 2%. So this is a very simple calculation of everything is just 2% more than the year before. I actually have another underwriting tool in this same spreadsheet that I got, and I believe this is done by I believe it's by an institutional lending person that does underwriting. When they do their calculations on these expenses, um, it's a lot more complicated, but they don't do that the same way. They go back and relate it to the year before. They divide the number out. It's a much more complicated, but it's a completely different scenario on how you come up with these numbers year to year. It's not just a straight percentage. So obviously, it's going to give you quite a bit different numbers by doing it that way.
Thank you, Tim.
Rebecca's question, do you actually take each figure and place them into your spreadsheet, or do you copy and paste it from like their spreadsheet or the OM?
Um, Fortunately, I cannot copy and paste because they don't have them in the same order that mine is. So usually end up having to type them in individually. Now, I will tell you, I don't do that the first shot through. Usually, what I'll do is especially like this income, I'll come down here and just enter all the other income in one column. I won't enter all these individuals here. And then usually on the expenses, I'll only enter in things like the payroll, repairs and maintenance, insurance and taxes, and then maybe utilities. And then all the other ones, I'll just kind of put it down here as a lump sum, the rest of the expenses. The reason why I do these is because I want to compare. These are the ones that are the biggest differences and can be the biggest differences between what the seller is showing and what we would use to underwrite. So I want to see what those are to compare, but some of the other expenses, it doesn't really matter. So I'll just lump them all together. So there's some shortcuts to do that, but I'll do that initially. And then when it comes time to really getting into the detail underwriting to know what you're going to, the returns that you're looking at and how you're going to present this to investors, that's when we'll go back and actually enter these individually. So I don't do this real early in the process because it is kind of time consuming.
And in the same note, what expense is the hardest to manage month to month?
Month to month would probably be probably it's toss up between the repairs and maintenance and the unit turn costs. The other ones are kind of, so to speak, out of your control. I mean, there's not much you can do with, utility costs are going to be what they're going to be. Insurance is what it is. Taxes, same way. Those are not controllable, but, your maintenance and repair and your unit turn costs are ones that they're big expenses, but they're also ones that you can affect, from month to month. And so I would say those would be the ones.
Right. I don't see any more questions in the chat. Do you guys have questions? Other comments, questions for Tim?
I hope this was helpful for anybody. I mean, I know I covered things a lot really fast. There's a lot here to go over. It's really hard to get into a lot of detail on how it works individually. So in the town that we have, but like I said, I mean, let me put my number in real quick. If there's more that you want to go over individually, I'm happy to do that. There's my number. If you look on the screen there, it's my number. If you want to text me and get together, we can do that.
A lot of people say super helpful. Definitely thank you. Great job. I think Tim did a fantastic job. Like Tim mentioned, his number's right here if you want to reach out to him. He charges about $1 million an hour, so be prepared to be prepared to pay up. No.
Don't put thoughts in my head, Jason.
All right. Any last questions around the underwriting, the stuff we went through? Again, we'll send this out. If you join the call, you obviously registered with the phone, with an email address and a phone number. So we will send this information out to you guys. So you'll get that. And then as Teresa mentioned, it's also going to be posted on our YouTube website. So you'll be able to watch it over and over and over again.
I put my number in the chat too. I guess I can put. I can also put our email address. So Brandon wants to know when I'm going to launch my underwriting course.
That's right. It's coming.
Sign me up.
Let's talk.
Very cool. All right. So we usually end at about 8:30. I want to go over just real quick. And so Tim, I'm gonna steal.
Oh, by the way, is Jay Miller still on?
I'm still here.
Yeah. I got your message about sending that. Teresa, will we send out can we send out the slides when you send out the recording to this, or do we need to do that separately?
I can send whatever that you send to me. Yes, whatever.
Okay. I'll send you the deck then.
The link to the recording. Yes.
Okay. So everybody on the call should get a copy of it.
Yep. All right. Let me
Appreciate
share.
you guys.
Can we get a copy of your deal analyzer too?
We can talk about that. Give me a call about that.
Yeah.
Okay, thank you.
We can
That's
share
another
a different
$1 million.
one. How about- We can share a different one. We can send out another. There's another one that we have a copy of that we can send out.
No, I want this spreadsheet.
I mean, this one looks pretty good.
Yeah.
The other one's really good too. Tim's is
I want that one.
There's a lot I have to explain. So just send this out.
I figure it out. No, you don't. I'll figure it out.
Tim's is a little hard to use. You might need if you do want Tim's, I guess, like Tim said, give him a call.
So I'm an engineer, if you didn't already know that, and I tinker a lot in spreadsheets, and I'm real bad about just going in and putting something in, and then I just leave it there, and sometimes, and then I'll be showing it to groups like this, and I go, "What is that?" And I'm like, "Oh, it's just, it may not even have anything to do with that deal. It may be something that just a thought that I had on something else."
Sounds like it's a better option to put in your own numbers, because the last thing you want to do is copy somebody else's bum spreadsheet.
Yeah.
Mess it all up on you.
I have a template that I start with that's completely blank. So, I mean, it wouldn't necessarily be getting this particular one, but.
Hey, can I ask a quick question before you guys go?
Yeah.
Sure.
So there was a deal out in past Arnold, Missouri that I was looking at, and I was asking for the financials, and I was told by the realtor that they would not release any financials until you put in an offer, and then you had to show proof of funds. So does that mean they're not really interested in selling?
It means that and don't take this the wrong way. They just don't know that you're they don't think that you're a true buyer. or that you're experienced enough to actually be able to take the deal down. I mean, that's typically what that means, especially when they ask for proof of funds. That's always the key thing.
How much was the deal? How big was it?
Let me look at it real quick because I told the realtor, I said, hey, we have a couple of investors that are interested in this. And let's see, I'll tell you where it's at.
They might also have a favored buyer in mind already.
Okay. Let me pull up the information. It's been on the market for a while. It's on Brookfield Court and it's 5 million. Well, actually, it's under contract now, pending $5,100,000.
So they
It's
probably already had, to Laura's point, they may have someone already in mind and they didn't want to waste their time necessarily with somebody who didn't have the funds.
Gotcha. Okay. It's 39 units. It looks pretty nice. So, yeah. Okay. Thank you very much.
I haven't gotten that yet, but my answer to that broker would be, oh, are you awarding me the deal? Well, no. Well, then don't worry about my proof of funds. Give me a CA to sign. We'll get the package and then we'll talk about it.
Yeah.
They typically call that a blow off.
Yeah. I usually tell brokers that I don't submit offers on anything that I haven't been able to analyze yet. So
yeah,
and
they wouldn't
typically I
even
don't
do a
typically won't
showing
look.
of it.
Yeah, I was going to say that's another thing that I've heard too, that people they say they want you to proof of funds or whatever, or submit an offer before they'll give you a tour. I was like, I don't offer on properties that I haven't toured yet. So
Right.
and I wouldn't recommend anybody do that either because I mean Teresa and I looked at a deal in St. Louis one time, looked great on the OM, and the property itself actually was great, but the location it was in just severely changed, what we were willing to offer on it. But we had already made an offer because we kind of found out about it last minute, and I ended up going back to them saying, "Wait a minute, that offer is not that's off the table now." So we don't do that anymore.
And St. Louis is probably like a lot of other markets, but I mean, there's a lot of pockets that are not good at all. And you can be right across the street from $1 million properties.
Yeah, we kind of stick to the three main ones.
Anything West County is good though.
Yeah. Creve Coeur.
Yep.
Creve Coeur. Yeah.
Creve Coeur, Frontenac, Ladue.
Yeah. St. Charles, anything in St. Charles County.
Oh yeah. Wentzville, O'Fallon.
Yeah. And steal the screen from you, Tim.
One picture. I've seen that one picture.
This one right here, right?
You have more though?
I do. Let's see. Can you see my screen?
Yes.
All right. So, like I stated in the beginning, let me just go through this real quick. So, this is the property that we're trying to close. Actually, we will be closing, I should say, around mid-May. It's kind of a hurry up and wait situation right now. We collected all the funds that we needed for the property. It's a 106 unit property in St. Louis, in the Creve Coeur area. So let's see if we can find some more pictures for you. So it's a old hotel converted into an apartment complex. So it was built in the 1990s and then renovated in 2023. So we're purchasing it at 14.9 million and we raised 6.3 million. So we'll be able to close on this property around mid-May. We're just waiting for the loan process, the longest process, to just finish up. And by the way, one of the things that we stated is Tim is going to go swimming in the pool. This is the pool. The moment that we closed, so he got lucky, and it'll be May and not January.
Polar bear plunge.
Exactly.
I want to go swimming.
Yeah, here's the pool. There's a basketball pickleball court here. I think they took the basketball part down because it was just too noisy. We're actually going to pull this all out and make it a dog park. Because we went through every single unit, all of us, and a lot of the folks, like 50+% of them, had pets. So we'd figured it'd be a better use of their time because they, this is kind of noisy because of the way the property is set. Um, Here's just some more pictures. These are the interior of the apartments. Here's again this. This is a obviously workout room. That is honestly the size of the workout room. It is very deceiving picture. It's more of a closet. So we'll be changing this out, taking this out, and either adding it if the residents want it to a bigger room, or just removing it altogether and turning it to something that they would find to be more useful. The equipment is all dusty, so nobody uses it. But here's kind of an overview of the site plan. And you can see right in the middle here is the pool and then that yard. That's where that whole pickleball court is. And so you can imagine it's quite loud and people really complain about the noise. And so we're going to change that to the dog park right in the middle. This kind of just shows you where it's at in St. Louis. We're kind of up here in the top corner, top west corner. This is the best areas to be in up here. And that's where it's located. And it just shows you all the places that you can work. Here's another view of it, but it then shows you specifically the school system. This is the best school system, not only in St. Louis, but in Missouri. So ranked #1 in Missouri. So the high school and the elementary school. And again, the property is located in district for those. There's a Starbucks too. Grant's always looking for a Starbucks.
Yeah.
This particular submarket is projected growth and occupancy. And so the other reason we really focused on this submarket is just because it has sustained the occupancy of 94, which the property itself has also sustained. And when we talk to a lot of the residents, they've all been there like 2, 3 years and they wanted to stay and they really enjoyed living there. So we, as a risk point, we saw that those tenants like it. It's for the last 5 years held itself at 90 to 94% occupancy. And then the market itself is projected to stay at 94%, as well as rent growth. I think we see rent decline in a lot of areas, not in this particular submarket.
Very nice.
I don't think I have any other pictures. This is the break-even analysis that we talked about. This is if you do a deck and you present something, put this in here because, like Tim said, this got the most questions and coverage. People really enjoyed this. They really enjoyed to see, okay, well, if I invest in this, I mean, the chances of 30%. I mean, we're talking about 35 people, and no one coming in. So not only have 35 people or families moved out, but nobody has come in. That is highly unlikely. You probably need some sort of a catastrophic event. So it really does show that the property can sustain quite a bit. And then we just talk about our business plan from acquisition to realization. The goal is to hold the property and then sell somewhere around the 3 to 7 year mark, depending on what the market looks like.
Nice.
This is how we use the funds. So we're going to take that $6.3 million and we're going to basically close the property, do some renovations, have some capital reserves, and then pay those wonderful closing costs. Here's again a picture of the interior of the property. It's very laid out, very nice. It's a nice living room. Depending on if it's 1 bedroom, 2 bedroom, the bedrooms are on opposite sides of the house. Here's our projected returns, 7 to 8%, 23 to 26%, 19 to 20, and then an over a 2% multiple on your money. And then like Tim was showing before, we do 2 tiers. So the 80/20 is the example here, and this is kind of shows you what $100,000 would return you at the 80/20 split. And then this is an example of the $1 million tier. You get obviously a higher return on your money because we're giving you a 90/10 split.
Wow. 90/10.
So that's just a quick run through of the property. We did fund the property up, so at this point, but if you're looking to invest for future deals, we are setting up a debt fund where we'll pay people anywhere between 6 and 12% return on your money, depending on how much you deposit. So we're still leaving an opportunity to get into other deals, but also collect a good interest rate.
Question, Jason.
Yeah.
I just came back in from the bathroom, so I missed part of this. Do you show a worst case scenario too, or do you just have that prepared in case somebody asks?
Worst case scenario in what? Like,
Well, you just showed the
so
best case scenario. Do you have
I
yeah,
think it was the break-even analysis
the break even
slide.
analysis. So we do. It's right.
okay? So you got a
Yeah.
break even analysis, and that's really worst case. Okay, thank you.
Yeah. So worst case scenario is we drop to 66%, we can still pay the bills.
Right.
And then there's a slight little return there for investors. But again, if you can imagine, if I'm running a property at 66%, it's probably unlikely that you're going to have many returns. But also, if I'm running a property at 66%, we have our own property management company. We should probably not be in the property management, right? Because we
Yeah,
shouldn't be running a property at 66%.
I would agree. Okay, appreciate it.
So,
Jason?
Sid, so I'll add on to that. So as far as so there's a lot of, we call them sensitivity analysis. There's a lot of different scenarios you can do on, worst case scenarios. We run several ones. Like we'll do one with increased expenses, one with no rent growth, different, cap rate exits, those types of things. There's so many different ones though, you'd make your slide deck so much bigger by putting them all in there. So usually I'll run those, some worst case scenarios, just to know what they are for our own purposes, to know, it helps us to know how good the deal is. And then usually anybody that requests that, I can usually run those and provide them, but we don't usually put them in the deck because there's just so many different ways you can do that. You're muted. So
Get asked for them very often.
we've had a couple people ask for them.
Okay. All right, good deal. Appreciate it.
Jason, I was going to ask, do you ever do like a calculation? What does a 66% break even turn out to in a vacancy rate? Is it one of those numbers that you'll never get that high of a vacancy rate? So don't worry about 66%.
We should definitely never get to that number. So, because really, truly, like the property currently is at 94. We're going to take it over at 94. Maybe we lose a person here or there in between. But it's going to somewhere between 90 and 94 when we take over the property. And I clearly lost the screen. And so we would then come in and take the property over. If we are managing the property and 35 people leave and we can't replace those 35 people, then this is what would be the result of that. So that's really kind of what we focused. It really is a most likely unlikely scenario to ever happen. But we wanted to more or less show it so that it can say, hey, look, your capital is safe because 35 families have to move out and we're unable to then fill that property back up or those 35 apartments back up. But worst case scenario, we could still hold your capital.
Yeah, I like it. It drives the point home. Yeah.
Yeah.
Yep.
How many
And
units?
usually they'll typically say 80%. Anything under 80% is considered good in terms of,
Right.
risk management. I mean, you got to think about that. If you were looking at deals and you saw one that was at 80%, occupied, you probably wouldn't even look at it, or even 85%. So, I mean, so it just kind of puts it in perspective. Is like, what's the likelihood then of it going to 66%? I mean, you just don't see that even on some of the worst properties. You don't see that.
Right. I mean, we've looked at a lot of properties and you definitely see 80s. I've not seen too many. I've seen a 0%, right? But you don't see very many that are for sale at 65% unless they're really in distress. And then there's a different opportunity there.
So your question about the vacancy rate, that 66% is occupancy. So that would be a 34% vacancy.
Vacancy rate, right?
So yeah.
Got it. Yeah, I think you just took the operating expense divided by the revenue, right? So it's a percentage of that.
The gross potential rent, the full, as if
Yeah.
it was fully occupied. Yeah.
Okay. Thank you.
How many units?
It's 106 units. I see some of these questions pop up. 106 unit deal.
Wow. Good price too. Great price. That was a
So
great price.
Right.
is it Adrian? Is that how you pronounce that?
Yes, sir, it is.
I wish you'd come along sooner.
Oh, man. Creve
Yeah,
Coeur is such a nice area.
yeah,
It's a great
we
area.
actually filled all the LP spots on this one. But we are still looking in St. Louis, so we'll definitely let you know about the next one we get in.
Oh, that'd be great. I appreciate that. And I was going to send you a text here shortly.
Yeah, I was going to say, send me your information so we we can contact you.
All right. Thanks so much. Great class, by the way. Love it.
So again, that particular property is filled up. We definitely focus in St. Louis, Kansas City area right now. We like Missouri. We think Missouri is a great location. Um, we are running a debt fund, hopefully having it up shortly. Once we do have that debt fund up, again, it's going to pay a steady for 12 months, 6 to 12%, depending on how much you deposit. So that could get you into the next deal. But really appreciate every single one of you for joining. Tim did a fantastic job as usual. We will send this out. And then if you want Tim's specific spreadsheet, reach out to Tim so he can talk you through it. Other than that, we can send out another spreadsheet. And we appreciate you all. Hope you have a fantastic rest of your Friday and weekend, and we will see you next weekend.
Yeah, thank you guys.
Thank you.
You're definitely
Thanks, guys.
informative.
Bye.
Thank you.